Hey everyone, welcome back to Corporate Decoder, where we decipher the documents that Wall Street hopes you'll just skim over. Today we're cracking open the annual 10K report of Commonwealth Credit Partners BDC, I Inc. or CCP BDCI. And let me tell you, there's more than meets the eye when it comes to this behind the scenes lender. So here's the deal, CCP BDCI is in the business of lending to middle market companies, but like a reality TV show, appearances can be deceiving. This report highlights some struggles and a heavy reliance on its parent company's expertise to stay afloat. We'll uncover how global events are impacting them, the uncertainty in valuing their investments, and whether their fee structure is really benefiting shareholders. Are they a shrewd credit partner or just another BDC building a house of cards? Let's find out. CCP BDCI is a business development company, which means they're in the business of lending money to smaller private companies. Think of them as a bank, but for businesses that aren't quite big enough to get a loan from Chase or Wells Fargo. They're externally managed, meaning they don't have their own employees, but rely on an investment advisor, Commonwealth Credit Advisors LLC, to knock all the decisions. That firm, in turn, relies on Comvest Partners for its investment expertise. The filing mentions that the investment advisor's resource sharing agreement with Comvest Partners can be terminated with 60 days notice. That's pretty big because if Comvest takes its ball and goes home, who's calling the shots? The stated goal of CCP BDCI is to make money. They primarily target middle market companies with EBITDA earnings generally between $10 million and $50 million and focus on senior secured credit facilities and junior credit facilities. Basically, they want to be first in line to get paid back if things go south. This is a key part of their investment strategy. But as we'll see, even a secure loan can have its risks, and these days it's like playing financial Jenga. This screams that they are worried about things outside of their control messing up their business. The economic world stage is mentioned, Russia's war in Ukraine, and the Israel-Hamas conflict. All of this adds, and which could cause portfolio companies to suffer. That means trouble for the lender because it is tough to get paid back by a business that isn't doing well. This is BDC speak for we're really reliant on certain people, and if they leave, we're in trouble. Think about it. These are the folks picking the companies to lend to, negotiating the deals and making sure they get paid back. It's a lot to put on a few people's shoulders. If those people leave, they're saying that. Now, for a tricky part, the valuation of their portfolio. The company says that, and that the fair values of their investments are determined by the investment advisor, subject to the board. That basically means they get to decide what their loans are worth, with a little oversight from the board. Sounds like a system ripe for potential conflicts, especially when times are tough. And since these are mostly private companies, it is harder to tell how well these investments really are worth. Kind of like grading your own homework. They're trying to set expectations and tell people that the fund is a special situation and you cannot expect to replicate previous successes, and have a lot of larger competitors that do not have the regulations and limitations that this company does. This could be a problem with achieving their investment goals. Alright, time to put on our counting hats, because here comes leverage. So they have to have 1.5x more assets than what they owe in debt. What that means is they can borrow up to $2 for every dollar they have. This has the effect of juicing any profits or losses. On December 31, 2024, that senior debt came to $111 million with an asset coverage ratio of 587%. If those assets are not covered 1.5x the debt, this could get dicey quickly, like when you max out a credit card and suddenly realize the minimum payments are more than you can afford. They also point out that what it means is that their debts can limit the ability to pay stockholders, which would also reduce their stock value. Here's something else to keep an eye on because of the way they make some of their loans. That means they might have to pay out dividends to stockholders even if they haven't actually received the cash yet. It would force them to sell off investments to pay those dividends, which is never a great situation. Finally, there's some regulatory stuff for the company. So that changes the oversight of the investment advisor. It could change what investment they make in general, since these can be limited to conform with service contracts between parties. This means the company needs to purchase a fidelity bond that will protect them if the investment advisor makes bad decisions. There's a clause in here that always raises eyebrows. The investment advisor really isn't responsible, and it's like saying, we'll give you advice, but it's up to you if you take it. If it goes wrong, not our problem. It seems like they have it stacked in their favor. So where did the company end up financially? Net investment income was looking pretty good. CCP BDCI recorded Approximately 79.7 million for the year ended December 31, 2024. This comes down from some 68.1 million the year before. That's a decent jump. But there are things that offset their revenues, notably as a bump up in costs. These increased from about 15 million to 18 million. In particular, the incentive fees are up nearly $500,000. There is an investment rating that is made by their investment advisor that goes from 1 to 6, with 1 being the best. That rating has gone up, showing they are taking on riskier and riskier and riskier and riskier and riskier investments. What's the verdict on Commonwealth Credit Partners BDC I Inc.? This is a smaller lender operating in a tough economic climate. They are still dependent on their manager Comvest Partners. Some risks have also been identified, and the increased portfolio risk is evident. All in all, it might be a profitable enterprise, but they are exposed, and that warrants caution. What are the takeaways? Keep an eye on that investment portfolio's performance and see how those economic risks play out. Also, see who they plan on reinvesting into and if they retain future assets. Thanks for watching this Corporate Decoder deep dive. If you found this helpful, hit that like button. Drop a comment letting me know what company you want me to decode next. And don't forget to subscribe for more plain English explanations of corporate documents. Until next time, keep following the money.